Hello, Nathaniel here in New York City at Federal Hall. Reason why I'm here at Federal Hall is that this is the place where George Washington was inaugurated president for the first time following the successful ratification of the U.S. Constitution by the original 13 states. Right behind me is George Washington's statue. I'm actually standing on the platform where he took his first oath of office. Coming down Broadway, he did his inauguration wearing a plain brown suit to not be overly dressed for the occasion. The reason why this location is important not only is Trinity Church behind me, the place where Alexander Hamilton is buried, but just over to the side here, that's the New York Stock Exchange right behind me with the columns. I'm here today to talk to you a little bit about the economy and about what the New York Stock Exchange and the stock market in general is actually a measurement of. Most people think that the stock market is a measurement of how the economy is doing. That's not entirely true. It's basically a speculation tool, no different from speculators looking for gold and silver in Colorado, California, and Alaska. People speculating for oil do the same thing. There are specific things that they look for in terrains that they speculate that they'll have a high yield of oil, gold, silver, platinum, yttrium, diamonds, rubies, anything. It's all speculation. The stock market is rooted in speculation, in supply and demand. I want this, there's only so much of it for sale, or I want to sell this, and everyone wants to buy it, and no one wants to sell it. There's a variety of different things. The stock market has been corrupted several times. In 2008, the most recent time the stock market was actually corrupted was done by market fraud. People withholding numbers, not releasing the real numbers. Lehman Brothers is an example of this, when they were inaccurately releasing their mark-to-market assets as far as their company value was concerned, which would have an impact on their stock value as a company as a whole. But for example, that's just one example of a good company, speculated as being a good company that's really not. So when the information came out that they were padding their numbers, their stock tanked. Then the short sellers, people who were prospecting that Lehman would keep going down, the market demand of buying shorts actually helped push the market down for Lehman, and is what ultimately led to other financial institutions no longer trading with them, leading to their bankruptcy since no one was able to trade with them. Regulation forbid someone to Barclays to outright buy them out, and so they were forced to declare bankruptcy. Other examples of when good companies or bad companies have gone up and down regardless of how strong the company is CVS. CVS recently announced that they were going to increase their minimum wage from where it had been up to $11 an hour. $11 an hour has now been a market rate for entry-level minimum wage jobs. McDonald's, Walmart, TJX, Target have all had $11 minimum wages for a while. And so in order to compete with this for the labor, CVS had to announce that they were going to raise their bottom line wages. Unlike the other retailers, they also announced that they were going to increase the wages of average and middle employees, so that when the wage went up, it did not actually pay more than the people who were already making more to begin with. So that's actually a benefit for their employees. However, what that shows investors is that their stock is going to go down. Why is their stock going to go down? Because CVS has already predicted what their second quarter numbers are going to be. With this announcement, it's going to change those outlooks. For example, when Walmart released the fact that they were going to increase their minimum wage up to $10 an hour and eventually up to a higher rate over 5 years, their stock price dropped over 5%. This because the company was going to be spending more money. The more money a company spends, the less revenue they have, and the less overall value the company has. So the stock dropped. Same with TJX. TJX announced a few months later, after Walmart's announcement, that they were also going to raise wages. This again because it makes the stock drop in value, because the company is going to have to spend more money on labor cost. People sold because the value of the stock was going to go down, because the revenue was not going to be up where they had predicted it. Why is that important? Well, at the beginning of at each quarter they have an earnings report. The earnings report is basically, we said that we were going to grow at 2%. All right, that's what our speculation is. Then the street, Wall Street, actually says, yeah, we think they're going to hit that 2% mark. Now, instead of hitting that 2% mark, say they hit 1.99, not quite 2%. So guess what? Even though they posted a profit, they expanded, they had a market growth. Since they did not meet their predictions, their stock value goes down. This works the same way with all companies. It's the way the stock market works. CVS, still a good company. TJX, a good company. Walmart, a good company. However, because of speculation of increased cost, their stock prices will go down accordingly. That's just the way the system works. During the robber baron period, time of like J.P. Morgan, which this building is right behind me now, what they did is that they knew how this worked. The value of a stock was only what someone said it was worth or predicted its future worth was going to be. So what they would do is that they would take a company and they would go buy as many shares as they could. Now, by buying these shares, by supply and demand, they would increase the value of that company's stock. Now, as the company's stock rose in value, what they would do is they called corner the market, all taking all the money, and then as soon as they felt like it was high enough, they started selling. Now, these are the people that everyone looked at as being, these guys know what they're doing, so let's do what they're doing. So the stock went up, they kept buying. As the robber barons started to sell, the people at the bottom would still be buying the stock, so the value would keep going up. So as the robber barons would sell, they would make profit on the differences between buying low and selling high. But as the bottom would fall out, because people would realize, oh, these guys are all selling, something must be wrong with the company or the industry, let's all bail out. And everyone started selling, and then the people at the very bottom who got on the buying platform last get hit with all the losses. This was made illegal, and with other actions like the Glass-Steagall Act after World War II and the Great Depression, this was trying to limit some of these behaviors. However, Bill Clinton, 1999, repealed the Glass-Steagall Act, allowing companies to have more rampant on-bridge power over other people's money. There's a famous story about John F. Kennedy's father getting his shoes shined in October 1929. And what happened was that the person shining his shoes was giving him stock tips. So that very same day, Kennedy went and sold all of his stock. Because if someone who's giving him stock tips is shining his shoes, maybe there's people who don't know how the market works well enough and are playing with a lot of money. The market's not stable. Now, there are other situations to where it's just a hiccup. The markets are going to have correction. Nothing's going to keep going up and up and up without going down. Right now, the stock market is going down because it's a normal business cycle. Because they announced higher job numbers and wages had been increasing across industries, that means that the companies are going to have less profit. Therefore, they're going to probably miss their quarterly earnings report marks. And so therefore, their stock price goes down. I want you guys to understand that's really how it works. There's a lot more technicalities to it, but primarily this is the function. It's all speculation. Now, I can tell you that, really low unemployment. Well, inflation is inverse. So the low unemployment, the higher the inflation. That's a market condition. When the dollar goes down, usually gold and silver goes up. So I would say that look for gold and silver to go up. Also look at, because when the dollar starts going down in value, people try to diversify their dollar holdings and convert their dollars to not only gold and silver and the commodities, but other currencies like the Japanese yen, the Swiss franc, and a handful of other currencies. Those countries don't like their currency going up so high, so they do quantitative easing to flood the supply of currency compared to the demand to bring their currency value down, which then will push the dollar back up in comparison and maybe push up gold and silver. This is supply and demand and trade-offs. That's just how it works. It's more complicated than this. This is not meant to be advice. This is just telling you what to look for and realize that the world is not ending. even though some say, oh my God, the market's going to crash. The president or the Congress doesn't have a whole lot of say here because, again, it's speculation. But if a president will come in and say, I'm going to regulate Wall Street around their neck, which probably means a lot more expensive business costs, values are going to go down. The president comes in and says, yeah, I'm going to let Wall Street be Wall Street. I'm not going to get involved with them. It means they're not going to have so many regulations. They're going to be able to post profits. They can be greedy, but in the short term at least, they probably will show a profit and the stock values will go up. Since the issue of the stock market over a 10-year period has only stayed down for more than a decade twice. The last time was the Great Depression, which means that within a 10-year period, even if the stock market shows serious losses from time to time, through that 10-year period, the market's value has gone up, which means the value of your investments in the first year of the decade will be higher than it was at the end of the day. Will be lower than it was at the end of the decade, which means if the decade ends, you will have more money than what you started off with. In general principles, that's how it works. Now in 08, it happened towards the end of the decade. So, but by 2016, the stock values have pretty much reclaimed all of their losses from 08. The economy was at a 3% growth rate. We're doing better than you think. Just because the stock market is doing bad doesn't mean the economy is doing bad. Sometimes certain industries go through changes. Remember, in the early 20th century, most people were riding horse and buggies. So the blacksmith had a lot bigger important value in society as he does now. So that industry with blacksmithing started to decline as the automotive industry started to increase. The values of automakers, Ford, Chevy, Dodge Brothers, would go up. While values of blacksmith and blacksmith tools are going to go down. But even in a complete downturn in the market, there are still things and companies, industries that are going to be successful, even if there's like a dot-com bubble or a housing bubble. People are still going to buy toothpaste. People are still going to buy deodorant. People are still going to buy cheese. People are still going to have to buy gas to get to work. So you're going to see oil companies still making a profit because people are going to be buying gas, and the economy is not at a complete standstill, so trucks are still moving, trains are still moving, people are going to eat, so places like Kraft are going to still have revenue. Johnson & Johnson, people are going to be buying medicines, people are going to be buying baby powder. That's not going to be affected as much as people think. So there are certain industries that are almost slightly recession-proof. Those industries are some examples. People are still going to have to buy basic things. So those industries that provide those basic things like healthcare are still going to be relatively safe places to put your money. Now, are you going to be putting your money in luxury items when the market's kind of going down or the economy's kind of fading? No, not a good time to go buy yacht stocks. But Kraft, Cadbury, which is owned by Kraft, good time to buy. Johnson & Johnson, usually a pretty good time to buy. Procter & Gamble, a good time to buy. Even though they might be laying off employees, and especially if they're going to be laying off employees, that's showing that they are going to be saving money. Therefore, it might be bad for those specific employees, but for stockholders, their value is going to go up because they're cutting costs. What works for the little guy sometimes works best for the big guy, and vice versa. That's just how this works, and I'm sorry some people don't get it. It's complicated. It took me years to really make any sense of it, and I still don't completely know everything. But I used to work in that building. I know quite a bit about the crazy shit that goes on in there, and here in a couple of years, you will too, because they're going to make it into a museum. Not everyone's supposed to know that yet, but it's going to be made into a museum here probably within the next 3 to 5 years. So everyone go in and look at, wow, this is where they fucked everybody. So anyway, that's it for this video. If you have any questions or want more information, write me. I can give you a little bit more details, but I don't want to make this a long video again. So thanks for watching and have a good day.